Hi, and welcome back again to Tim Bigham's Big Time Options. We'll be taking a look today at why IV matters, certainly in this recent market environment. A put spread comparative from back then till now that shows you just how much IV matters. So let's jump in and take a look, shall we? First of all, here's an actual trade that I generated on Friday, mid-morning or so for the Cobra. Just saying triple Q's finally finding some footing after a severe sell-off. We'll take a look at the chart in just a second here. IV at the highest levels of 2025, but finally starting to soften as well. So we always like to wait for the curl, we call it, right? Don't jump in front of it if it's moving in the same direction. Once it slows down and starts to head the other way, then we'll take a counter trend position. So our trade idea was to go out and sell a slightly out of the money 455, 460 put spread on the triple Qs for about 75-cent net credit or so on the trade. Certainly getting a nice net credit given the level of cushion we had at the time. Triple Qs were trading above 480. So let's take a look first of all at that IV we were talking about. IV at by far the highest levels of 2025, but beginning to soften. You can see Thursday's close. Friday still extreme to say the least. Highest level since Valmageddon Part 2, right? Last August, but finally starting to give back a little here, which sets up ideally for our put spread trade. So I just went back and took a look at the last time triple Qs were trading at a similar level till now. So here's the option montage from September 26th. Triple Qs at 485.82, right? That 460, 455 put spread was trading right around 19 cents at the time. So here it is, the 460, 455 put spread, 12 days to expiration. Qs at 485.82. Out of the money, that 460 strike price, 25 points and change out of the money, or over 5% cushion on the trade. IV at the time on the trade, roughly around 22 IV. The net credit you could have gotten on the trade, about 20 cents. So not too big a net credit. You'd risk 4.80 simply taken by the spread width of 5 points, less that 20-cent net credit. So your return on risk, not too great as well, a little over 4%. So in other words, your risk of $480 to make 20 bucks. So let's then take a look at it when we put on the close. Actually, we'll take a look in a second when we put the trade on Friday. But here it is on the close on Friday. You can see the Qs did strengthen on the day, up about 3.5 points when we put it on. The Qs were actually down on the day. So we're starting to see some of that reversion, at least for one day on the trade. You can see on the close, Qs at 491.79. They had 460 strike price, again, the same 460, 455 put spread, right? They had 460 strike, would have been a little bit less than 32 points out of the money, or about 6.5%. When we looked back then, it was only a little over 5%, so certainly a bigger cushion on the trade, right? So you have a bigger cushion for the trade to go against you. The net credit on the trade, it closed at about 50 cents, which is very nice. Again, the previous one closed at 20 cents, so you're getting a bigger cushion and a bigger net credit. We like that combination indeed. The risk on the close, 4.5 bucks. Again, difference between the strike prices, 460 and 455. So if you would have put it on the close on Friday, you would have gotten a little bit over 11%, which is certainly a much better return than a little bit over 4%, to say the least, on the trade. Then we can take a look at a couple other comparatives, right, as far as then and now for the same net credit, right, looking back then, right, to get that same kind of net credit of around 50 cents. Here it was 48.5 cents, right? You'd have to do the 471, 466 put spread, right, instead of the 460, 455. So you'd have to get 11 points closer to the money, right, to get that same sort of net credit, or you'd only be out of the money by about 3% instead of now you'd be out of the money by over 6%. So basically, you're doubling your cushion for the same net credit. That's one approach to take. Or do another approach, right, which is simply going back and looking for that sort of same net credit back then as now. So looking for about 20 cents here, you would have been able to sell the 441, 436 put spread, right, instead of that 460, 455. So you could pick up 19 cents more cushion on the trade, right? Or about a 10% cushion for the same net credit of 20 cents, right? But back then you would only had about a 5%, so you could certainly double that big cushion out there. We put it on, as we said, on Friday morning. Here's the actual fill price, as you can see, as far as getting filled on the trade. Most people got in somewhere around 73 cents or so on average on the trade. So the Qs were at 486.13, right? So that 460 strike price, 26 points out of the money, or about 5.4%. IV at the time, 35, right? So a very high IV. Again, these are both 12-day to expiration, so days to expiration we kept constant, right? That net credit of 73 cents. Risk would now be 427, right? The 5-point wide spread with less the credit received of 73 cents for a very nice risk return of just over 17%. So as long as the market doesn't drop an additional 5% or so, you get to make 17%. Compare that to that previous time, right? I pulled it off here and put it up, right? So the triple Qs were at 485.82 at the time. So the Qs are actually a little further out of the money. Even when we did the trade, right, they did rally up and close higher on the day, which helped our trade that closed, as we said, right around 50 cents. So out of the money by 25 points and change back then, 26 points here. So a little bit further out of the money, a little bit bigger cushion, right? But the big difference, right, is that net credit, 20 cents back then, 73 cents when we did the trade. So our risk return, right, went from a little bit over 4% to over 17%. So basically, 4 more times return, right, with a little bit bigger cushion to do the trade now versus then. So that's what we look to take advantage of here in big time options. Put those edges in our favor. At the end of the day, we'll see if the trade works out, right, because probability, not certainty, is the guideline to trading. We don't know what's going to happen, right, because you just don't know. It's the market, right? But as long as you can continue to position size properly, take advantage of those perceived edges. And when you look at it on the chart, right, we like those triple Qs simply on a technical basis as well. We could see that they were getting oversold. Here is 9-day RSI finally bouncing off that 25 level, right, which is deeply oversold. MACD got to the biggest discount of the year, basically, of the past 12 months, starting to strengthen. Bollinger percent B went negative, now it's turned positive. Here's IV again, a generalized number, again the highest level since Volmageddon Part 2. And lo and behold, the last time all these technical indicators aligned in a similar manner marked a significant low in the triple Qs. And even the previous time was a very nice time to be taking a counter trend bullish position. Rather than jumping in and getting just long triple Qs, we prefer to take advantage of the big jump in IV, get further out of the money, get a bigger net credit, and position to be a buyer on a further drop. So until next time, as always, here's the good trading. Take care.